Banks rejected 1 in 5 mortgage applications last year. But there's a legal way to buy a house that banks can't reject, and it could save you $150,000 in interest. I'm talking about seller financing. And before you skip this thinking it's some sketchy back alley deal, it's not. It's how people used to buy houses. It's how smart investors are buying houses right now. And if you're stuck in the rent versus buy trap because traditional lending isn't working for you, this might be the answer. Let's break it down. First things first, what is seller financing? Here's the simplest version. Instead of borrowing money from a bank, you borrow it directly from the person selling you the house. They become the lender. You become the borrower. The house is the collateral. That's it. No underwriting department, no 45-day closing timeline, no jumbo loan penalties, no PMI insurance on your mortgage. The seller essentially becomes your bank. Why would a seller do this? 3 reasons. 1, they want to close faster. 2, they want more money in the long run through interest payments. 3, they want to offload a property that won't sell to traditional buyers. For you as the buyer, why does this matter? You bypass the bank's credit requirements. You bypass their debt-to-income ratio gatekeeping. You bypass their appraisal games. If you have inconsistent income, a credit dip, a recent job change, or you're self-employed, all things that murder you at a bank, seller financing doesn't care. Now let's walk through how this actually works. 5 steps. Step 1. Find a motivated seller. This is critical. Not every seller will do this. You're looking for people in specific situations. Inherited property they don't want. Foreclosure situations they're trying to avoid. Out-of-state owners who just want cash flow, or property that's been on the market too long. Real estate agents know who these people are. You can also find them through wholesalers, off-market deals, or direct mail campaigns. But the point is, you need a seller who's motivated enough to become a private lender. Step 2. Get a professional inspection and title search before negotiating. This isn't optional. You're not using a bank's underwriting to protect you anymore. You are the insurance. The title company will confirm the seller actually owns the property and has the right to sell it. The inspection protects you from inheriting a $40,000 roof problem. Don't cut corners here. Step 3. Negotiate terms directly with the seller. This is where seller financing gets interesting and where it gets dangerous if you're not careful. You're negotiating the down payment, the interest rate, the loan term, and whether there's a balloon payment. A traditional mortgage gives you 30 years and a fixed rate. Seller financing could be 5 years, could be 15 years, could be 10 years with a $100,000 balloon payment at the end. Common terms look like this: 20 to 30% down, 6 to 8% interest, 10-year term. But there's no standard. That's the flexibility. That's also the danger if you don't know what you're doing. Step 4. Put it in writing with a real estate attorney. I'm going to be very direct. If you skip this step, you deserve what happens to you. Seller financing deals live and die in the paperwork. You need a promissory note that spells out exactly what happens if you miss a payment. You need a deed of trust or mortgage document. You need default clauses. You need to know what happens if the seller dies, if they get sued, if they sell the note to an investor. This isn't a handshake deal. Get a lawyer. It costs $500–$1,500. It saves your $400,000 house. Step 5. Close through a title company and set up automatic payments. The title company handles the deed transfer. You set up automatic payments, and I mean automatic, so the seller gets paid on time every month. The moment you start missing payments, this deal turns into a foreclosure situation faster than traditional mortgages. The seller can foreclose on you just like a bank can, sometimes faster, depending on state law. Okay, now the question you're asking, what could go wrong? 3 major red flags. Red flag 1. The seller still owes money to their own bank. If the seller has an existing mortgage they haven't paid off, their bank gets paid first in a default situation. You could be paying the seller every month while the seller's bank is foreclosing on the whole property. Suddenly, you lose the house even though you were paying. Solution: require a title search that confirms the seller's mortgage is paid off, or require the seller's bank to approve the seller financing arrangement in writing. Red flag 2. Balloon payments you can't refinance. Say you do a 10-year seller financing deal with a $150,000 balloon payment due at year 10. Year 10 arrives and you try to refinance with a bank to pay off the balloon. But interest rates spiked, or your credit took a hit, or the market changed. Now you can't refinance, and the seller can foreclose. Solution: make sure any balloon payment has a refinance clause. If you can't refinance, the seller has to convert it to a longer amortization, or you have the right to walk. Red flag 3. Predatory interest rates and terms. I've seen seller financing deals at 12 to 15% interest. That's predatory. That's not better than a bank. That's worse. You're paying for the seller's laziness in vetting you. Solution: know the current market rate. Compare terms. Don't get desperate. Let's talk real money. Let's say you're buying a $400,000 house in a market where banks want you to have a 20% down payment, a 750-plus credit score, and a debt-to-income ratio below 43%. You have $80,000 down, a 680 credit score, and you're self-employed. Bank mortgage, rejected, done. Seller financing deal, $80,000 down, 20%, $320,000 financed at 7.5% interest, 15-year term, monthly payment, $2,508. Compare that to if you could get a traditional bank mortgage, same $80,000 down, $320,000 financed at 6.5%, bank rate if you qualified, 30-year term, monthly payment, $2,023. So yes, the seller financing monthly payment is higher, $4 to $85 more per month. But you got into the house when the bank said no. Over 15 years, you've built equity and own the property free and clear. Further, if you find a motivated seller who'll do 6.5% or lower, you've basically matched bank rates without needing a bank. That's the real win. Here's our bottom line. Seller financing is not a hack. It's not a shortcut to responsible borrowing. It's a tool, and like any tool, it works when you're doing the work. Due diligence, legal documentation, reasonable terms, realistic repayment capacity. The housing crisis has priced out millions of people from traditional financing. Banks have tightened lending standards to the point where credit score alone disqualifies qualified buyers. Seller financing isn't perfect, but it fills a real gap for real people in real situations. If you're stuck renting because traditional mortgages feel impossible, if you're trying to move fast on an investment property, if you have non-traditional income or a credit situation that banks won't touch, seller financing deserves serious consideration. Just do it right. Get the inspection, get the title search, get the lawyer, know the terms, understand what you're agreeing to. Don't let desperation drive the decision.